Well, thank you, Gabriel. Thank you, Karel, Sergio, Michaela. Well, after a bumpy start for me personally to this conference, lost luggage and a taxi driver who complained the whole way long from airport to the hotel about Chancellor Merkel's politics. I made it finally here to the hotel. Well, at the end of the trip, I admitted that I'm an MEP from Germany belonging to Angela Merkel's party. So then he, of course, was a little bit scared if he would get a tip, but I tipped him pretty well. So we had a good end of our trip. Well, thanks again for inviting me here to the Insurance Europe conference this year. Like Gabriel, I think it's a couple of times now in a row that I will be able to attend this wonderful and interesting conference, and of course, I'm personally be very honored to have the opportunity to speak again at this conference. This year, however, a fundamental point changed because we went beyond talking about Solvency II and are actually applying Solvency II. So good news, at least from a policymaker's perspective. Insurance business faces definitely a period of adjustments. Firstly, from a regulatory point of view, which is determined by obligations to apply new capital risk management and governance standards, to implement revised distribution rules, and to prepare for international capital requirements. The first months of the Solvency II application passed, and with the permanent and temporary long-term measures included in the directive, the transition towards the new capital system has been, from my perspective, successful. Furthermore, the calibration of long-term infrastructure investments was recently improved. The transitional for investments in equities has been extended. The charges for investments in European long-term investment funds, so-called ELTIF, and in projects of the European Fund for Strategic Investment have been adapted to facilitate an engagement of the insurance sector. In addition, the calibration of simple, transparent securitization will be soon modified. We had some discussions in Parliament, but earlier this week we made very clear in our committee that there's a clear expectation that this will be soon modified. The first major review is envisaged by the end of 2018, when the components of the standard formula and the effectiveness will be assessed. And moreover, during the next 5 years, we will see regular assessments of the long-term guarantee measures by EIOPA, based on which the Commission will be in position to provide an overall medium-term evaluation of the measures. For now, the legislators have the task to stabilize the basic framework and to provide legal certainty for companies and stakeholders. And there's pending legislation beyond Solvency II. The revised insurance mediation rules and the establishment of an EU-wide pre-sale key information document will demand further adjustments from the insurance sector to comply with the new set of requirements. The implementation of the Insurance Distribution Directive has to be done early 2018, and the preparations for the key information document should be completed by end of this year if the Commission is ready to deliver in time to the Parliament and the Council an agreeable set of technical standards. Ladies and gentlemen, it is a priority for the Parliament to ensure that the co-legislators' decisions are fully respected when the EIOPA and the Commission make use of their empowerments for delegated acts, technical standards, or guidelines. And no surprise for Gabriel, he is used to being closely watched by the European Parliament. And furthermore, with regard to the specifications by means of delegated acts and technical standards, there's a good reason to take account of the specificities of insurance products. They have a long-term nature and long-term insurance benefits which cannot be found to the same extent in alternative investment products which are bank-based or even fund-based. Where those differences become relevant, they should have an effect on the design and the specifications of the rulebook, even more as the distribution requirements for investment funds and those for insurance products are set out in different pieces of legislation. And the work on the delegated acts and technical standards for the Insurance Distribution Directive are still in their preparatory phase. Parliament is ready to closely collaborate with EIOPA and with the Commission to enable a smooth process and to achieve solutions that are in line with the guidance set out in the directive. With regard to international regulatory level, 2 milestones have been achieved by finalizing the basic capital requirement and the higher loss absorbency requirements for globally systemically important insurances. The IAIS work on the international capital standards for internationally active insurance groups is further progressing. Knowing about the increasing internationalization of this business and the benefits and risks attached to it, the European Parliament has been fully supportive of defining international capital standards. But nonetheless, as a co-legislator on the European level, the European Parliament has a legitimate interest in avoiding contradictions between international and EU requirements, as well as in the limiting inconsistencies and incoherencies between the 2 frameworks of the extent possible. Our political demand to improve the accountability of standard-setting procedures in international financial organizations was recently reiterated in a plenary resolution. Furthermore, we consider the implications of the international standard setting to also be relevant when it comes to evaluations of the impact of the legislation applicable to European financial services companies. And it was the European Parliament which initiated a cumulative impact assessment of the regulatory package that has been launched and completed since the outbreak of the financial crisis. The Commission has been obliged to deliver a stock-taking exercise on the entire financial services regulation, including those parts that are covering the insurance and reinsurance business. Lord Hill mentioned it during his video message. And the first consultation, the so-called call of evidence, has been completed, which I, as rapporteur of the respective Parliament report, of course, very much welcome. A Commission study by the end of this year shall further elaborate on the findings and set out possibilities to adjust and to adapt existing rules where inconsistencies and incoherencies are proven or where a lack of proportionality and effectiveness is observed. The stock-taking exercise will also be useful to pave the ground for future initiatives of the Capital Markets Union. The additional regulations to come in the CMU will be more effective, the better the current regulatory puzzle fits together. The Parliament does not perceive the Capital Markets Union to be a standalone project for the enhancement of capital market-based financing to companies. The CMU shall be of a broader scope and a larger impact, involving in a holistic approach all kinds of financial services actors which may contribute to improving the EU-wide access of companies to funding. It goes without saying that the insurance sector shall, to the extent possible, also have a role, a prominent role, in the future CMU legislation. The adjustments faced by the undertakings on the regulatory front are, however, not the only ones to elaborate on. Ladies and gentlemen, let me secondly come to the economic point of view. In economic terms, the situation for the insurance industry has been rather challenging for already quite some time. The delay of reforms, the slowdown in fiscal consolidation, and the decrease of competitiveness in member states have a growing impact on the prospects of the European economy. Not many member states were as successful and effective as the Irish, who, if you allow me to say so, are surely an extraordinarily positive example for rigorous, successful measures in regaining economic health. The policymakers in Europe have the obligation to ensure that the rules we once adhered to when the Economic and Monetary Union was founded are again fully enforced. This shall be equally done for small and for bigger member states. And this has also to be done based on objective criteria to avoid attempts of politicizing the process. This is the only way to give proof of the reformability of our European economy in times like this, in crisis times. The engagement of the European Central Bank bought more time for member states to make necessary economic adjustments. And for reasons of stabilization, it was certainly right to do. However, it is not right if this extra time is not effectively used. After almost 7 years of extraordinary ECB action, we have to recognize that adverse effects of the quantitative easing become more and more apparent. We face a decline in interest rates which we have never seen in Europe, before. The provision and the profitability of financial services are affected as a whole. The variety in asset allocation and investment opportunities decreases further. And the remedies we take from a regulatory point of view may help to achieve more and better asset diversification. However, they are not designed to deal with all roots of the problem. And we will need a larger response to tackle the availability of long-term financial products and thus retirement provision for the European citizens. Insurance companies and pension funds are best placed to guarantee that the retirement provision is not only largely left to the public sector. With the huge demographic challenges ahead of us, a comprehensive political response on member state and EU level is definitely necessary to safeguard the role of long-term insurance and pension provision. And part of this response has to capture the range and diversification of insurance and pension products. From a product point of view, many adjustments in product policies have already been done or initiated, in particular in the life business. A shift from defined benefit to capital preservation and defined contribution products can be observed for quite some time. And while insurance companies, in order to capture economic uncertainties, understandably aim for more flexibility in the design of their products, the consumers may face more difficulties in understanding and in comparing the benefits of the products. Furthermore, it will be detrimental if the fundamental feature of insurance, the long-term nature of the product, which implies long-term security for the customer, is lost. One initiative that may help is the development of a pan-European pension product, the so-called PEP. The European Parliament is in favor of establishing a PEP. However, we also point out that many obstacles have to be addressed before the design of the PEP can be further specified. The debate on the PEP has to find suitable solutions for the establishment of defined contribution systems, in particular with regard to the long-term investment and diversification capacities. The debate has to address present obstacles in the transfer of cross-border pensions, as well as in the fragmentation of national taxation regimes. And it will be important to ensure that the PEP will become a simple and transparent product from a consumer's perspective to ensure a high level of acceptance and, of course, a positive reputation. Further initiatives to foster product diversification may arise from financial technologies. The reach out of fintech in Europe is heavily growing, and according to market research, consumers show interest in using fintech solutions not only for payments or simple bank transactions, but for traditional insurance as well. This illustrates a further need for innovative product solutions, which leads to the question of how to frame the business of fintechs in regulation and supervision. The Parliament will soon start its work on an own initiative report to launch this debate and to develop a first position on the integration of fintech and fintech products in the financial services regulation. While product regulation has for a long time not been in the focus of the European Parliament, the situation has here definitely evolved. Also due to the fact that the European supervisory authorities share some competences on product oversight with their colleagues from the national authorities. Where the Parliament will be able to play a positive role in setting the right parameters for product availability and product diversification, it will certainly fulfill this role. It's very important. We spoke a couple of times in our committee on that, but we will be fully aware of our role here on this. With all the ongoing adjustments and changes in mind on the regulatory, the product, and also on the economic level, the commitment of this year's conference serving our customer in tomorrow's world is definitely a demanding one. So what can be done further in order to positively contribute from the perspective of an EU policymaker? Well, I would say we should definitely address the difficulties for customers to access insurance products on a cross-border level. While insurance cooperate internationally, the insurance solutions are still mostly national. The single market for businesses is much more advanced compared to the single market for consumers, and therefore work has to be done to lift barriers and to enable equal consumer protection across the borders. A holistic approach in the Capital Markets Union, including the announced action on the retail financial service, will help to identify obstacles and to take action to remove them. Then secondly, we should carefully scrutinize the results of the impact assessment and stock-taking exercise of the European Commission and react where improvements in the regulation are needed, with the aim to achieve a consistent and effective insurance regulation which fits to customers' needs. Thirdly, we should use the stock-taking exercise and the regular assessments of EIOPA on the long-term guarantee measures to evaluate whether the availability of long-term products is secured and how the provision of long-term guarantees can be strengthened. Then we have, moreover, to proceed with the implementation of increased transparency as required by the Insurance Distribution Directive. This includes the establishment of a key information document for insurance-based investment products, which shall cover the main features, costs, and benefits of the product, and of course ensure equal comparability with alternative investment products. I know that this is a big topic at the moment. We will definitely have a look from Parliament's side within the next weeks on that issue. That's the only message I could give you today, but I can assure you that's clearly on our agenda at the moment. Then, fifthly, it is also important that we work on possibilities to foster product innovation. Fintechs promise quick and simple access to insurance coverage. Their future role in the distribution of insurance products shall already now be anticipated to prepare for solutions which integrate both traditional and newly digitalized services. And last but not least, we should definitely stabilize the main regulatory framework under Solvency II, which substantially strengthens the capital adequacy, the risk management and the governance, the reporting standards, and thus, in an overall sense, the resilience of insurance undertakings. Serving customer needs is served best in a well-capitalized undertaking, being able to offer transparent, risk-adequate, and profitable products. And policymakers are able to set the scene in a sense they provide an adequate and effective policy framework. Ladies and gentlemen, at the very end, it will be the undertaking's responsibility to foster the customer relationship. Insurance business is about promises and trust. It is about delivering to the customer in times of need. The insurance business was able to deliver rather successfully in the past, also during times of crisis. And European policymakers will provide the available support to ensure this success continues. Thank you very much.